Shubin, thank you for coming on the program this morning. Now, we just heard from Tom there that the NDRC has come out and said 8 to 9% is the contribution of trade to GDP. How do you put that together with what you're saying, net exports are negligible when you talk about Chinese growth?
I think you have to put it in the context of China's new development stage. Right now, China relies much more on domestic forces than global forces. And the 8 to 9% driving force from the global economy is because of the recovery of the global economy, but is not something that the Chinese economy relies on. 2 years ago, it was negative contribution from net exports, but China still grows very fast. That's my point.
Now, someone would come back and essentially say, yes, perhaps it's negligible, the contribution of net exports, but it's still an industry that employs a lot of people. And from that, I would imagine that fuels things like consumption and how large the services sector is. So how can we say exports are not important if it still employs a lot of people, essentially?
I think for these people who consider unemployment consequences from less exports, they probably underestimate the flexibility of China's labor market. Actually, in the past 5 years, China has gone through radical transformation in terms of industrial structure. The manufacturing sector has gone down to below 40% of GDP, and the service sectors are now accounting for more than 52%. So I think even without any negative hit from job of exports, still China is going through a huge transformation in which laborers jobs are reallocated from manufacturing to services. So whether it's low exports or high exports, Chinese people will have to adjust their labor skills to find new jobs, and it has been going relatively smoothly. So I don't think a big hit in terms of less export is going to add more on this difficult transition, and it is still it's going on, and it is inevitable in China's current stage.
Now, overall, they came out with a growth target of about 6.5%. Now, given the current structure of the economy, Shubin, do you think that that's easily achievable without the buildup of excess leverage and essentially where money supply is kept constant?
I think one thing that has changed fundamentally from past, say, 7 years to the next 3 years is that the government of China is now very much relaxed in terms of achieving the so-called doubling income goal from 2010 to 2020. Because of the surprisingly high growth rate of last year, 6.9%. That reduces pressure for the Chinese government to achieve the goal. In my calculation, China only needs 6.3% on average in the next 2-3 years to achieve the goal. So I think that sets the background for the Chinese government to shift attention towards dealing with the deleveraging, excess capacity, rather than the growth rate. So coming back to your question, is 6.5% growth rate achievable this year? I say yes. Not because that there is not going to be a real effort on the other reform affairs. China will pay a lot of attention, which will somehow reduce the growth rate by say 0.3, 0.4%. But I think if we really analyze what China has been doing last year, we can see a lot of new momentums from the service sector, from the new economy, from this urbanization, and these forces will continue to carry China for another 5-10 years. I think that is why I think we who are living in China are more optimistic about achieving this 6.5% goal, which is nominal, than many experts overseas.
But Shubin, 6.5% at a time when we're seeing sharp policy tightening, can China achieve that without implementing stimulus to support growth?
I think we will see withdrawal of stimulus policies this year and next year and the next year. And I think the reason is because China has a solid base already in terms of growth achievement in the past 7 years. For many of us who live in China and analyze in China, we actually consider 6.9% growth rate last year is an underestimate. So I think the government has left some room, for the future. And so I will say that this year there will be less fiscal stimulus, as you can see from the work report of Li Keqiang, that the deficit GDP ratio has been adjusted down. And also, if you are running business in China, you know that money is now very tight, which means that the government or the central bank is actually tightening, towards the tightening, at least neutral, monetary policy. So given all this, will it affect China's growth? Of course. But how much? I think the government has said 6.5%, left or right? I mean, about 65%. I think this year, if I predict, I would say China will show a 6.4%, which on the one hand is reaching the target. On the other hand, it is showing the world that we are serious in dealing with these more fundamental issues by sacrificing a little bit of the growth rate. So 6.4 may be the actual growth target in the mind of Chinese leaders.